Hey everybody, it's Chris Englebert with Englebert Financial Advisers in Allentown, Pennsylvania. And guess what? It's the first of the month update for April. What are we going to be talking about this month? We are going to be talking about FOMO, fear of missing out. Now, why is FOMO the big topic right now? Well, guess what? We have now had the S&P 500 up 5 months in a row from the October 2023 low. And many people are saying this market is just going to keep going. I got to get in no matter what. Now, I've been in the investment business for a long time, and I can tell you, I have seen more money lost by people chasing overextended, highly valued stocks than just about any other strategy that I've seen out there. So we again are trying to tell our watchers to be very careful about chasing stocks like Nvidia, Google, Microsoft, Netflix. All of these stocks that are extremely extended can come down rather rapidly. Again, I'm not talking about a stock market crash here, but I'm talking about overvaluation. So let's talk about interest rates a little bit. The Federal Reserve is really backpedaling on the number of rate cuts that they're looking to do here in 2024. Remember back in December, January, they were starting out with, oh, we're going to lower interest rates by 1.5%. They've quickly backed off from that because of strong employment numbers. Well, this past week, we got some hot inflation numbers. And to us, it looks like the Fed is not going to be lowering interest rates till probably after the election. So we think that the 10-year Treasury is locked in a trading range between just about 3.8% and just about 4.4%. Whenever it gets up to that 4.4%, looks like a good time to extend duration and buy longer-term bonds. Because eventually, we do believe that the Fed is going to lower short-term interest rates, but it could be much later in 2024, possibly even into 2025. Let's talk about valuations in the stock market. And again, valuations in and itself is not a timing tool. Like, hey, our valuations of the market hit these obscene levels, sell everything. Or, hey, valuations are extremely low, buy everything. But there are times out there, and we believe we're in one of those times where investors have to pay attention. So this is a Bloomberg chart, and you can see we've charted out. The white line is the S&P 500. The blue line is the dividend yield on the S&P 500. And what do we mean by that? Whenever anybody talks to you about dividend yield on the S&P 500 or earnings for the S&P 500, the S&P 500 is an index of 500 stocks. Each stock, most of them pay some type of dividends. So what they do is to show the dividend yield on the S&P 500 is they add up all the dividends that are going to be paid by all the stocks in the S&P 500. And you can see that back during the global financial crisis in 2008, 2009, when the S&P 500 was extremely low, the dividend yield was over 3.5%. Turns out that that was a very good inflection point as far as a cheap time to buy the S&P 500. Well, now if you fast forward, you can see over on the right-hand side, the white is the S&P 500, and you can see back in 2020, the S&P 500 dipped. Dividend yields rose on the S&P 500. It was another good time to buy stocks. But now you can see that we are way over on the right-hand side, and we are at a historic low on dividend yield on the S&P 500, and we're at all-time highs on the S&P 500 index. So one of two things has got to happen. We either have to see dividends start to come up, or possibly the price of the S&P 500 index start to come down. So we use these indicators in a macro sense to try to tell us when risk is high in the market or risk is low in the market. And right now, risk is elevated when looking at the dividend yield of the S&P 500 versus the price of the S&P 500. Another one that we're looking at is what are bonds as far as valuation goes versus forward earnings. So what happens on the S&P 500 is all these individual stocks have earnings projections by analysts over the next 3 months, 6 months, 9 months, a year. You can chart these earnings projections against the 10-year Treasury yield. And right now, I told you, 10-year Treasury yield is about 4.3%. As of this video. And if you chart this, you can see that way over on the right-hand side, looking at forward earnings, you know, what companies are expected to earn for the rest of 2024 into 2025 versus yields on the 10-year Treasury. Guess what? bonds are very cheap right now. Stocks are expensive. If you look back in the 2008, 2009 global financial crisis, we have up here stocks were cheap. And then stocks started to get a little bit more expensive come 2009, 2010. Then you can see they got cheap again. And this spike over here on the right-hand side in 2020 was obviously COVID, when stocks were cheap in the spring of 2020. So right now we have a situation where, looking at forward earnings on the S&P 500 and comparing those earnings to the yield on the 10-year Treasury, bonds are cheap, stocks are valuations are elevated. So what does that mean? Well, as of March 2024, the S&P and other major indices are up 5 months in a row. A consolidation or a pullback would be normal. We would actually think it would be healthy for the rest of the year. AI stocks are cooling off at this point in time. The chip stocks are cooling off. But lo and behold, the baton is being passed to the banks and energy stocks. We've seen the price of oil. If you've watched some of our other videos, we are concerned about the reignition of inflation because oil prices are creeping up. But oil stocks are also creeping up as well and doing very well. So the leadership in the market is kind of being handed off from technology to banks and obviously energy stocks. But our bottom line is our risk indicators are still elevated, especially when you look at the valuation levels of stocks. And I repeat, it's not a timing mechanism where you say, hey, valuation levels are high, sell everything. Valuation levels are low, buy everything. But it does help to be a guide and say, hey, listen, if I've got fresh capital to put to work, if I'm making a IRA contribution, maybe we hold it in the money market fund, which are right now paying 5% in a low risk place, and look for a better opportunity for the rest of 2024. So that's the April update. Again, this slide deck is on my app. You can download my app by texting Chris E, that's CHRISE, to 36260. So if you want to see this slide deck, you can get it. And then again, we also mail this video or email this video out to everybody. You'll be getting it next week sometime. So thanks much for talking to us. The first of the month update. We'll be back next month. Take care.